and welcome into this week's show. Freightonomics, Zach Strickland, head of freight market intelligence, here with you solo today for a little bit. Hopefully, Dr. Rogers will be joining me shortly. But before we get into the LMI and the latest release there, we've got to talk about the winter weather situation that has, of course, thrown the freight market into massive chaos and disarray in the month of January and now early February. We did have two winter storm events that have really blown through the market. And this happens every year. Over the last 3 years, we generally get a pretty decent sized storm or a couple of systems that come through the market or come through the United States, and they throw the world into chaos for a couple of weeks. This just happens to be one of the most fragile freight markets that we have had in recent years. I think most of the operators out there would agree that the last few years have been anything but eventful. They have not been that volatile. We've been seeing a consistent oversupply of capacity that largely arose from a capacity glut coming out of COVID. We saw this with, the rate inflation that occurred during COVID really drew a lot of operators into the environment. Barriers to entry relatively low. Over the last year, we've seen an increased focus from a lot of the agencies to regulate and kind of enforce some of these regulations. And that is starting to show up. And so the market's cracking, so to say. But before we get into too much detail and storylines here, let's look at the market in two. And I guess I'll be counting myself in today. 3, 2, and 1. All right, going through the recent week's data. This is by far and away the most interesting data point that we have right now. Tender rejection rates skyrocketing. And more than the absolute value of the tender rejection rate, which is now over 14%, the highest value that we've had since early 2022, when the market was actually stabilizing. The speed of increase here, we jumped from 9.8 to over 14% in a matter of 2 weeks. This winter storm is the pure cause. We know that for sure. Ice and snow laying a swath across the parts of the Mid-South, Texas, up into New England, obviously covered there. A lot of disruptive activity, and that has really punished the market. Let's go to the next chart. Looking at tender volumes on the next one here. And normally we don't really see tender volumes being a component of capacity side events. We do have some shippers that it looks like they have had a little bit of backlog that they've pushed some freight out. So we've got a demand side spike. We're now above year over year by a decent clip. Now, some of this is rejected tenders, and it is worth noting. But we do have a demand side component here. I do think this will wash out, and we will get a lot less push from the demand side here in the coming weeks, although it's going to take a few weeks. Let's go to the next chart. Looking at spot rates. On the refrigerated side, they're on top, RTI, the refrigerated spot rate index, and on the bottom, NTI, the dry van spot rate index. And you can see the big bounce there. This is just to show you another data point that this market is absolutely in chaos right now, going above Christmas levels for both refrigerated and dry van spot rates. Let's go to the last two maps here that I want to show. The WRI map, this is a rejection-focused map. All the dark blues indicate the fastest and highest levels of rejection over the last week. Still in the dark blue after a week. And, we've got Charlotte, North Carolina sitting there in the Carolinas. Go ahead and throw the last map up there. I'm going to go into overtime by a little bit. This is the dry van spot rate map. Everything in blue, almost entirely outside of Lakeland, Florida, down there. And it just goes to show you that just because the winter weather hit in a certain stretch of the United States, the entirety of the market is impacted because you have downstream influences from all the carrier networks and the shipper networks. I just talked about a high level of demand coming out. You don't shut down a plant for a couple of days and then just come back to work with the same amount of business to handle. So the market's probably going to be a little bit chaotic, I would assume, probably for the rest of February. But I do want to get a little bit of hot take from Dr. Rogers here in a few minutes. So on the economics side of things, we did have a few data points to discuss this week. The ISM, this came out, the PMI, the Producer Managers Index. This is the manufacturing-centric version of the LMI, if you will. And, you have the same type of thing, above 50 expansion, below 50 contraction. This is the PMI, which is the total manufacturing sentiment. And then you have the green there, which is going to be the new orders component. This looks fleeting. Reading this report, this looks like a little bit of a, we talked about this with Dr. Rogers last month about inventory levels being surprisingly low, or they contracted at a surprising rate for the manufacturing side as well. And this looks like people were caught off guard and they needed to replenish a little bit more. So consumers did show up a little bit because every single sentiment indicator that you read of the ISM was very negative. Still, manufacturing remains challenged in a lot of ways. The tariffs are still a component of this. Not a lot of optimism, although if you've watched this show, if you've heard me talk before, I don't put a ton of stock in feelings. I like looking at the data points specifically. So there is something to this rise that I would not completely dismiss as just a pure fleeting moment. The next data point that we had this week, and there's a little bit of contention, obviously, around the jobs and labor numbers when you look at the BLS figures and the ADP figures. ADP, for those of you that don't know, that is largely a human resources software product that is in a large number of businesses across the United States. Probably several of you are on this system. They do these monthly reports about job creation. We had 22,000 jobs created in the private sector. They do not cover the government activity. But this is, of course, a large component of the economy. We want private sector jobs being created. That's very positive. 22,000 jobs created in January. Not great. They were expecting around 42,000. I don't know who they are, but they were expecting a lot higher figure here. This is right in line with where we've been economically from a labor market perspective for several months now. I'm not saying that this is a good thing necessarily, but we've got a fairly decent full unemployment rate. There's a few nuances there on the supply side of that equation. We've lost a lot of labor participation over the last several months too, which is probably helping tamp that down. But the people that are looking for jobs in the United States, they're largely employed for the most part. So we're not moving though. And I think that's my big takeaway here is that economically we're stagnant and not going many places. So that being said, it doesn't, there's still some optimism built in, but for now, and a lot of this data is lagging, we're at least in a holding pattern. So let's transition into Dr. Rogers and talk about the LMI this week or for the last month. And I'd really, I know I just showed the baby brother version of the LMI on here, but I'd love to get your hot takes here. What do you think about all that?
We love the PMI. There are friends over there, all part of the MI family. Zach, before we get started, I got to get you what's going to be I think your saddest piece of data for this call. It's 65 degrees today in Fort Collins. I don't know if you're getting snow when you come out here, man. I think you might be going for hikes, which are lovely. I don't know if
I mountain bike.
A lot of powder for you when you're
Maybe I just rent a mountain bike and let it happen. The weather, I love that. I think we've gotten more snow than you guys.
Oh, 100%. Yeah, no, that's true.
I know Nashville has for sure. And those poor souls up in my hometown are still dealing with that. Trees and everything. That's going to take a while to recover from. That's some bad stuff over there. But yeah, winter weather really, everybody puts so much emphasis on tropical systems and tropical weather and transportation. And they've had some really big systems. Obviously, Harvey was a huge influence, but it was flooding in Houston, one of the largest freight markets in the United States. But winter weather has been the new hurricane since arguably maybe since 2014, 2015. But really, the winter weather events have had far more impact on the freight market over the last bit. I wrote a chart of the week about it, and you can see the headline there.
It's been huge, going up and down the 95. I mean, one of the reasons we saw, I think, capacity as tight as it's been on transportation. Yeah, there's restocking happening, of course, just like you mentioned. But some of this has got to be the snow.
Yeah. Oh, it's undeniable. I mean, each year, like when I was an operator in the space, January and February were basically just like, Kevin Hill probably said it best, cat meme sharing time. Like it was just the slowest, most uneventful time of the year. And I wrote this chart of the week with little circles around what the disruptions were, and that's what they're showing right there. Every January, the last 3 years now, we've had a pretty decent impact. Last year was a little bit of a meh, but this year for sure, strongest system having in the most fragile market environment I think possible. So I think people too dismiss like the liability that carriers take on during these conditions. Like ice storms, you can't do anything in ice. Like people are like, the Southerners, they can't drive. And, and it's, and it's like, well, nobody can in ice because we don't have any equipment to deal with it either.
Right.
Yeah.
Yeah. Well, if there's no infrastructure, like I remember when my family moved from Michigan to Nevada when I was a kid, and my dad talking about, there's only 3 plows in this town. In Michigan, everybody had a plow they could just put on the front of their truck. And Reno, it's like, we had 3 guys, and that's it. And so I do think the infrastructure piece is a big part of it, and that actually, I think, transitions a little bit into the numbers for this week, because we have a really funny report where overall everything is up. We're at 59.6, which is up 5 points from last month. And, because last month was a very kind of slow reading but it was like a slow reading only because we had this gigantic just push down of inventories. Right. Our inventory levels last month were, and you alluded to this, were 35.1, which is the lowest number we've ever had. And like for retailers, it was like 28. I mean, it was truly, I think we've only ever had, a number in the 20s one other time. And that was like September of 21 for transportation capacity, when everything was just tighter than it's ever been. And so we go from that to growth in January, but it's mild growth. And the growth for inventory levels is 53.9. And so a lot of times with inventories, you expect them to be kind of like a rubber band where you pull one way, snaps back the other way. Isaac Newton would love it. But you have a sort of equal and opposite reaction. Well, in January, to be at 53.9, I went back and looked. December of this 2025 just happened, was our lowest ever reading for inventory levels, but also our lowest reading ever for a December. This 53.9 for January is our second slowest January we've ever had. So it's a funny combination where we have this really low December where we really got stuff off the books. And then in January, yes, we are building things back up, but not to the level that you might expect if we're looking at this through a 2025 lens. But we really can't do that. We have to look at it through a 2026 lens. And what that lens says is, for the last 6 months, all of our respondents in the future predictions have been saying, well, 2025 was all about, big stocks of inventory. 2026 is going to be all about turnover and moving things really quickly. And the idea was, from the predictions, is that inventories will stay low, but it might juice the freight market a little bit because we're turning things over so quickly. Last year was high inventories, very static.
Yeah.
2024 was low inventories and some movement. 2023, which was kind of the last year where these dynamics from December to January held, was very low inventories, but also very static because just nothing was moving in 2023. Right. So now in 2026, we have a different situation. It's sort of a hybrid in some ways of 2023 and 2024, where inventories are going to, I think, stay low the way they were in 23, but they're going to move fast like they did in 2024. And so what that has done then on the freight side is our transportation capacity for the second month in a row came in at 47.1. And that matters because, it was 36.9 last month, I should say, but it came in as a contraction for the second month.
Right. Yeah. There we go.
And so 36, 47, that means capacity's tightened 2 months in a row. Well, capacity hadn't tightened since the spring of 2022. And I think a lot of it is because now I do think some of it is snow, honestly, but a lot of it too is now we're turning things and we're turning it more quickly. And you all see that reflected for transportation prices came in at a 71.4. That's the fastest rate of growth for transportation since April of 2022. I thought it was funny that I saw Craig had a post on LinkedIn. I think he was talking about rejection rates or something. I can't remember exactly what he's talking about, but he said, this metric that we have on Sonar, this is the best number we've gotten since, and it was also April of 2022. Right. And one of the things he said, now that April of 22 was we were on the way down, and hopefully here in January 26, we're on the way back up. And that is kind of what we're seeing on our transportation metrics. Now, I don't know if it's going to stay as robust. We did see in the second half of the month, our numbers slow down a little bit. I always look at the interplay between capacity and price. So for the first 2 weeks of January, when we really saw, one, the big storms, and two, a lot of the restocking really pick up after the holidays, transportation capacity was 44.1, prices were 75.1. So a 30-point gap there. Second 2 weeks of January, it was 49.3 for transportation capacity, 68.4 for price. So we went from a 30-point gap in the first half of the month to a 19-point gap in the second half of the month. Now, I don't want to minimize that. In 2023, we would have killed for a positive 19-point gap.
Yeah, right.
So it's not like we slowed down, but the rate of that burst we saw, similar to you, I don't think that's a sustainable sort of trajectory. Right. I think that was us sort of blasting out of these doldrums. And what I would expect, and this is kind of what our respondents are expecting, is now we'll sort of be at a steady, elevated, certainly from 2025 and 2024, sort of plateau here where the freight market is strong. And I would guess we're going to continue to see capacity hover right around that high 40s, low 50s, telling you, the market's in relatively equilibrium. And because that, we are able to see some price growth because it's all about turning these inventories as quickly as possible. Despite 53.9 for inventory levels, inventory costs are 71. And that, by the way, is the 12th out of the last 13 months that inventory costs have been moving in the 70s. And anything over 70, we would classify as a robust rate of expansion. And so inventories continue to be expensive. And that, to me, seems like the driving force of the supply chain strategies that we're seeing right now, which is let's turn this stuff over quickly so we can try to optimize our cash flow. And it seems like, at least for now, that's good news for the freight market.
Yeah, I totally agree with that. We do have the transportation chart for price and capacity. I love the alligator mouth, as it opens up here. It's not a great sign for the shipping community, but it's interesting to me that this one, you had that capacity kind of bounce up. It's still in contraction, like you said, but it's like an interesting divergence. Like normally these things have an inverse relationship. And for this month, they sort of moved in tandem. And I was curious about that.
Yeah, so I think a couple things happened. One of the things that's interesting, I think, in January is we saw such a swing towards OTR. Last year, especially the first half of last year, it was an intermodal fiesta. I mean, intermodal was so big last year. And we've seen, I think, year over year, intermodal's down. The other thing, I was looking at stuff coming out of the Port of LA, and it's 3x what's leaving on trucks right now versus rail out of the Port of Los Angeles. And that, I think, gets back to it's a velocity story. 100%. So last year, because we were building everything up, it was okay to go a little slower, keep things on trains, little more cost effective, because we didn't necessarily actually want inventory to get to the next step that fast because we already had too much. It's too expensive. Right. Now it's really a speed situation. And so because we're more on speed, I think we're seeing a lot more OTR. than
Right.
intermodal. And I wouldn't be surprised if that's a trend that continues this year. And
Mhm.
so then if you're thinking about it like that, well, even if we're using the same amount of capacity or even a little less, if the cost per mile, cost per load is higher as it's going to be, that could explain some of that we're moving together. The other thing I would say is that, remember, even though it looks like on that graph you just showed like capacity went up,
Mhm.
it
It's
did
still contraction. Yeah.
down more slowly. Like it was
Right.
going down, and now it's going down at a slightly less steep rate. But it's one of those things where, the marginal returns on tightening capacity gets higher. Like for every point we go down in available capacity overall, you might see a bigger uptick in price because of the sort of marginal returns of, going from say 50 to 45. You may not have the impact as going from 45 to 40 because of the way that, the economics of supply and demand work.
Yeah, I mean, now we probably lost a few people there when we started getting too deep into the math, but
Good.
but I totally get what you're saying. Like, yeah,
I want strong people watching.
yeah,
If you're a little
we
scared
do
by
have.
marginal returns,
Oh, for
go
sure.
watch Cartoon Network. The FreightWaves is not for you.
Yeah, you'll definitely expand your brain if you came here for some supply chain math. So my question here is there anything in the recent print of the LMI that suggests that, I read all the sentiment stuff from the ISM, and it was largely negative. And
Yes.
is there anything from your reporting or your surveys that kind of has a different take on things? Like, I feel like we've had this interbreeding of political news and business news that's really kind of made it muddy to read like the true like environment that we're operating in. Is there anything there that promotes like the fact that we just had, it's a fairly, like, we haven't really lost any ground in terms of demand, and a lot of the shipping communities demand forecasts are they're still questionable. Is there any confidence returning there?
One thing I think we're seeing that is interesting is that last year we had a lot of divergence between our smallest and our largest respondents, where a lot of the pressure of the tariffs got put on our smaller companies. They were sort of like the holding companies, basically, just physically holding all this expensive inventory right until their larger partners needed it. We're not seeing that this year. We had, I think, on average, the average inventory levels for small firms in 2025 from January to October, and October is when the inventory transfer happened, was 75.5. This month, it was 53.9, which is the exact same number as our large firms. So small and large firms now are holding the same levels of inventory. Now, what's interesting is our large firms actually also are reporting higher costs. And that's because I think some of them are located more closely to consumers. The larger firms are reporting much tighter transportation capacity. And I think what that shows is it is the big guys who are doing the really fast turnover, more so than the little ones. And I think that might show up actually in a couple months in some of these sentiment indexes.
Mm-hmm.
One of the things that I think has made sentiment so much different from reality, or like, the overall numbers, maybe not reality, but sentiment different from the overall numbers, is we have had a real divergence in socioeconomic status, and, the 50% of spending is coming from 10% of the population, and all that stuff. And if you looked at I'm going to go back to those ADP reports. If you looked at the ADP reports in the fall, small companies lost 160,000 jobs. Large companies added about 175.
Right.
And so a lot of it coming out in the wash. If you look actually this month at the ADP reports, the large companies actually have lost jobs.
Right. Yeah.
Like, UPS and Amazon and Home Depot. And the small companies actually broke even.
Mm-hmm.
And where the growth was in the middle, like the 500 to 1,000 group. And so I think we're seeing, last year, one of the sort of byproducts of the big stock up was little companies were like the human shield in front of the big companies. And now that we're going to this high level of turnover, I don't think we're going to see the same pressure on small firms. And so if I was looking anywhere for green shoots, and of course, look, the political stuff almost always is going to override economic realities. But if I was looking for any green shoots, I would say that small firms are in a much better position coming into 2026 than they were in 2025. I don't think they'll be as sort of abused as they were. And that could certainly drive up some sentiment, especially, honestly, from some of the folks in the lower SES region. And maybe what I would love to see, we like the alligator mouth for transportation prices and capacity. I don't love it for the K-shaped economy. I would love to see those lines come back a little closer. And I think that's really where you'll see an improvement in sentiment. And some of one of the things that gives me hope is that the smaller firms look like they're in better shape this year.
Yeah, that's fascinating because the small groups were just not as set up to handle all the volatility and the trade policy. No. They don't have the infrastructure to handle this type of environment. And even though they tend to be more flexible, they're not more flexible in their own lane. Like if your lane is getting run over, there's nothing you can do. I actually talked to people that do business in the Netherlands, and this latest round of political noise in that space really disrupted their business because of the assumptions they had to make and thinking, well, is this going to damage is tariff's going to become a thing? And that when you're talking about losing a month of business, like that puts you out of business. So they can't, it is serious when you're talking about, even if it is, people are like, oh, it's just negotiating tactics. Yeah, but it's public-facing negotiating tactics that people have to take seriously.
And you saw the EU making a deal with India now.
Yeah,
making a deal with Mercosur. Canada, what just happened to electric car tariffs in Canada? 100% to 6%.
Right.
They're real, guys. Even if we're just using them as negotiating, the other people aren't.
It matters. It totally matters when you're doing it in the public sphere. You have to that's financial markets too. You can't, that they're moving on some of these, even though a lot of this stuff never happens or materializes, it does move things. The last thing I want to get to when we have 2 minutes left, obviously the forward-looking stuff. Where are we at in the next year? Did anything change there meaningfully?
The biggest thing I think is we are continuing to see a divergence between our upstream and downstream predictions. If we look at retailers, they're saying 59.1 for the overall index for the next year, which is just about exactly where we are now, which again leans into this constant sort of replenishment, strong freight cycles, all that. Upstream is 66.6, which shows actually fairly robust growth. And that's really driven by higher inventories, which in turn leads to tighter warehousing capacity. They're predicting warehousing capacity to be at 50. So basically we're breaking even there. Much higher prices at 77. And then actually both of them have similar levels of transportation, both at 42 for capacity, 75 for price downstream, and 81 upstream. One of the things to keep your eye on with that, though, is we've got 81 and 77 and a 76. So we're getting right up to, if you look at the upstream aggregate logistics costs, right up to around 240. We're in the high 230s, and the last time that we were around 230 was May of 2022. When inflation was relatively high. And so one of the things I have my eye on here is the increased activity, because it's not just increased activity, it's increased activity with tariffs on top of it. If all of that cost does become inflationary at some point, especially upstream, because you could then see that maybe slowing down some of the manufacturing plans and delaying CapEx. And so the supply side inflation is, I think, something to keep eyes on, because other than that, if you check that out, freight market looks like it's in good shape because of where turnover is supposed to be for the rest of the year.
Yeah, the volatility looks good until all of a sudden it slams the door shut on you. Right. So if we get too much,
too close to the sun, prices are great until they're too high.
Exactly. All right, man. Appreciate it, everybody. Thanks for watching. Have a good week.